Okay, folks, welcome back. This is the third part of a discussion on changes in state of delivery, algorithmic order flow. All right, so we're going to look at the euro dollar again. Now we're going to a little bit deeper into the price action and drop down into the hourly chart. But again, just for the purposes of showing exactly where we're focusing, this is the 2020 price run we did a complete coverage of from beginning to end, starting from the daily chart. And I'll counsel you to remember, going through all the commentaries, I mentioned that by the time we got around Christmas, we would be trading up here, and this would be the draw on liquidity. And ultimately, this is what we had here. But I want to take your attention into this price run right here initially. So while all this is still fun, you have to start with the first price leg. So we're going to focus in on here, which led up to the levels we see here. So we're going to drop down into the hourly chart. So that shaded area on the daily is this segment of price action. I'm going to zoom in and I'm going to cover some salient points here, and then we'll flesh it out as we go. At the beginning of the move, the buy program, as we've been outlining in this lecture series, the idea was that we were expecting price to potentially trade up to those relative equal highs over a longer period of time, not an immediate price run. It's something that you have to obviously submit to. And on these lower time frame charts, it's fun. We can see things, get immediate reward and feedback. But the higher time frame charts, it takes a lot more time to submit to that, which is the number one reason why I said mentorship should be at least a year long, because it allows me to flesh out these really big moves, and you watch and you submit by force how long it takes for these things to pan out, and then counting all the opportunities in between these daily candles coming to these higher time frame targets, how many opportunities make themselves available to harvest pips that could be used to parlay and account equity many times over exponentially. So it doesn't mean that we have to submit to just this move, get in one time and hold it, but for those that are in the mentorship that have that disposition that it fits very comfortably with, you can see that we can still outline these bigger moves. It just means that I'm not really interested in them because I lose interest real fast. They're boring to me. Even though there's thousands of pips available, it's still boring to me. Like, I need to see more action. So I'm like a dog chasing cars. I'm looking for the next car. So the buy program starts here, and we had obviously some consolidation down here, which is accumulation. And then we have price running through this old high. Now, classic support resistance theory would say, okay, this is an old high broken here, and if price comes back down to that level, I want to be a buyer. And that's what all the books that I bought said. Many times I tried to do that, I lost, and it would be these types of events right here. Now, I'm going to give you some homework. You can go into your own charts and dress your own chart up on the hourly and look at an indicator, and you can pull up like slow stochastic, and you can see as it traded down into that old high here, this low and this low right there created its first bullish divergence in an indicator. Now, it's blasphemy around here for me to put a chart up with indicators on it, so I'm going to avoid doing that. But for your own study, I want you to take a look at that, and you can see how that divergence right there, that would have been a trade I actually would have taken back in 1992, 1993. I would have bought this market with that idea because of the divergence, not because of what I'm going to show you here. Okay, this is the reason why what we teach is not supply and demand. It's not classic support and resistance. It's not break and retest. It's none of that stuff. Okay, it's deeper, as you'll see. So the logic is this high being ran out. That's fine and great, but I want to know, where's it going to go to? Because there's many times the market won't even come back to this old high anyway. But if it does, what am I personally looking for? Well, we're going to cover that. So the buy program starts here, and that low is the first primary reference point. So we have this low up to this high. So there's our two key price levels. So between this high and this low, we have to run a PD array matrix. So you have to find out where equilibrium is, okay? To save you the eyesore of looking at a chart with all this stuff on top of it, trust me, if you do this on your own, you'll see that this is the equilibrium price level, or 50 on the fib, all right? So we have a very bare minimum of price trading back down to the 50 level. So if we're bullish, and we're assuming that we all agree that I was outlining this year, and you can go back and watch the videos as well, we were bullish on euro, and once it trades to this price point here, that's indicating that the market is at equilibrium, or while bullish, that is discount. Okay, so at equilibrium or less, and it's bullish, that is a discount market. So at that price level right here, we have to start looking at that level and below for all discount arrays. So right away, we have relative equal lows here. We have a buy side imbalance, sell side inefficiency. We have a bullish breaker, last up close candle here, and mainly the imbalance right there. Okay, so watching this low right down here, that's, well, not low, but that high rather, that's what we're going to focus on. That would completely close in this buy side imbalance. So what are we looking at? What are we seeing here? What we're seeing is the initial stages of a high resistance liquidity run, even though the market is bullish. Why is it high resistance? We had a market trade high here, then a higher high, then a higher high. So we had basically a three Indians pattern. This pattern is taught in the Street Smarts books by Linda Rasch and Larry Connors. It was one of the first patterns that I liked for reversals, but I got sucked into thinking that this was going to reverse and go down to here, because that's what classic support and resistance said, that if it can break through this old high here, like it did, that means it's going to go down to here, or here, or here, or here. That's what I gleaned from the books when I first started. Clearly, you can see we've evolved from that. Okay, so the high resistance signature is the fact that we have a high, a higher high, and now even a higher high. So all the highs are successively higher. So this was all running out liquidity, specifically seen as a return back to this displacement right here. So it returns back to rebalance, but don't lose sight of this signature here, because this is high resistance. That we'll talk about when we get further into the video. But for now, just know that this buy side delivery, it's running price higher, going to buy side liquidity here, but it's offering buy side delivery, running into buy side liquidity here. That's why sometimes when you hear me talk about, okay, it's going to run to buy side liquidity, a neophyte trader or someone just watches a hand-me-down video of me talking about runs on liquidity or relative equal highs, they assume erroneously that just because it runs above that, it's running out stops to go the other direction. No. You have to know what you're doing. You have to be able to read price and know what it is that price is doing. That's mentorship. That's what I outlined this entire year with euro. This buy side delivery, it's imbalanced. It's only been offering buy side, so it has not offered efficiently any real opportunity for sellers to trade short or offer in this range between the high here and the high of this candle, what's being highlighted with this blue line. Each high here, we have buy side liquidity here, it runs it. This high here has buy side liquidity, which it runs it as well. And then it breaks down. What's actually occurring there? This is a shift in market structure. It is not a break in market structure. Okay, it's just shifting within the context of an underlying buy program. So this low, when it was broken right there, that shifts market structure to bearish, but only on the near term. Why? So it can go back down below this low to rebalance this buy side imbalance. before it trades down there, it trades back up into a premium fair value gap. Once it rebalances that, then it's okay to see it trade lower. It trades down into that old high, which is retail resistance turn support. Does it rally? It gets a little sputter there. Then it goes a little bit lower, goes up one more time, and then drops aggressively here. So what is this occurring? It's offering a run on the liquidity that would be engineered right below these lows. So when you're looking at your charts every day, your routine should be based on what is the underlying narrative based on the things I'm talking about in the commentaries, where I'm drawing your attention. These are the things that you want to start looking at. And if you can't see it before it happens, that's fine. Go back in hindsight and fill in all the details like I'm showing you here. Now, obviously, I see these things as it's happening and before it happens, but I'm giving you the context of how you should build your own charts and also teaching you at a deeper level of why I was able to see what I was expecting in Euro this whole year. This run on these relative equal lows, the old high, the algorithm's pausing here, and it's giving the opportunity for traders to pile in and buy there. And when you see these little runs like this, stop loss orders are going to form and start pulling and congregating all underneath that low. And what kind of stops is it going to be? Sell stops, which is exactly what smart money wants to see at this imbalance. Sellers, a big crowd of willing sellers to sell at a lower price. So that's what happens. The algorithm will go down there and offer the opportunity for traders that know what they're looking for on an institutional level to buy that up. It wasn't sellers that took it down there. The algorithm's just repricing to that price point. Then traders that are aware of what's going on, they buy this. Okay? It's not the buying and selling pressure that pushes price to these levels. Because if that was the case, we would see many times these imbalances be overshot and have really no consistency. There's no symmetry. But because price is absolutely delivered by an algorithm, it's controlled down to the pipette and by time. So when you see these signatures like this, it's hard to argue with it once you really go into it and you look for it. And it might be for a new student or a layman looking at what I'm describing here, it's okay, well, you're just reading into it what you want to say, and you're torturing it, and it's obviously submitting to you with enough force, and abuse, you can make a narrative out of anything. Spend more time studying it, and you'll see right away that doesn't hold water. This is an absolutely controlled market, and all the markets now have moved to this electronic format where it's algorithmically delivered. It's efficient. They don't need a whole lot of intervention unless it's required for their personal interest. And from a central bank level, there's so many things that would cause or inspire that type of manual override, but it still once in a while will happen. Most of the time, it's autonomous and it's doing what it normally does anyway. But price trades down into the imbalance and then runs higher. Trades above this high. There's your short-term shift in market structure. Now, I don't have it identified like it does here, but this is a shift in market structure to the bullish side. What's different about that? This is short-term down to a discount. This right here is a change in the state of order flow. So there's an algorithmic transition from buy side, the market's offering buy side, and then it goes down into that buy side while it's acting as sell side. Okay, so there's a change in the state of delivery in the price where it was offered on sell side here into an area where it was only buy side. When you have that happen and the narrative is bullish, this is where the signals form. This is how you quantify the buying opportunities, whether it be a breaker, whether it be a fair value gap or an order block. The fact that the algorithm is going into an area where the state of delivery is changing to a previous state of delivery. And it's basically saying this: where there was buy side offered only, when it drops into that as sell side, that is what keys up the algorithm, and it matches up sell side delivery in an area when there was only buy side. Once that occurs and the narrative is bullish, that's when price will change on a dime and start going up. That's how you've been able to see me do these examples where I'm recording and I'm buying and it's turning right on a dime and it has very little drawdown. I'm teaching you that right here. That's what this lesson is. I'm teaching you the internals of why order blocks and imbalances constitute a setup. It's not just it's trading to an old candle. There's logic behind that. And you have to know what it is that it's doing. It's not just simply, oh, it's going back to the order block and we'll just keep it simple. No, the fact that it's got an imbalance here, why does it need to go down there anyway? Because this is efficient delivery of price, and this is what traders are looking for. They are not buying this and then driving price up because they bought it. The algorithm is already going to go up from this point here. Traders on an institutional level may miss this opportunity. That's the part you don't understand. And the people that are on YouTube or making courses and trying to rename all my stuff and think they understand order block theory, listen, you have no idea what you're talking about. Okay, you're doing more harm to people listening to you than you're helping. You sound smart, you sound like you're an ICT clone, but you have no idea what you're talking about. What I'm showing you right here is the internals of what makes that algorithm do what it's doing. How does it reprice higher? Once it does its job of rebalancing the buy side, once it does that as it goes into sell side. So it's basically saying this: the candle goes up on one singular candle. That's not efficient. But look what's doing here. It's going down multiple times, okay, in a stage where it goes down a little bit, consolidate, down a little bit. It's offering and spending time down there where sellers were being offered the opportunity to get in there. Why? Why would they want that to happen? Why does the algorithm program to do that? Because traders are going to see this as a bear flag. They're going to want to go short. Okay, they're going to sell more. Not just the sell side liquidity here, but they're going to flood the market in all of this because they're going to chase it, thinking it's going to drop lower. So they're pushing all kinds of traders' sentiment into thinking it's bearish, 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 when it's nowhere near bearish. It's all bullish. So you have to look at the contrast between what is the imbalance and how does it trade there. It changes its state of delivery, not a singular one candle down like it does here. It's doing something, and you have to think about what is it doing. What I just outlined here, it's putting in more sellers. And once it does this and rebalances, the algorithm is not aware of how many people bought or how many people sold. It doesn't know that. It doesn't know your specific stop. They don't have that there's no book like that, okay? The idea is everybody's stop is going to be where everybody's stop is, because everybody's drinking from the same pool and the water's tainted. It's the same stuff I taught on baby pips in 2010. We have not changed or deviated from that. Price starts to reprice higher, and it cues all the traders that will be waiting for this signal here that is aware of what the algorithm's doing. Once they see this break here, that's a shift in market structure on the bullish side. Now, again, what changes? We are now in alignment with the buy program after it's been rebalanced and overcome this impulse of sell side liquidity. It's been flooding the market here on two levels, with buyers trying to buy here and they run at, or they go down and then go down again, rebalancing this buy side area here. So it's not like usually you expect like a single up candle and then over here a single down candle and it rebalances. It can happen that way, and that is usually a consolidated range environment where it'll rebalance like that. But generally a strong trending market, you'll see something like this many times if you drop down lower time frames and you look inside this imbalance. So what may not be showing on a hourly chart here, this same thing could occur in a 15-minute chart where it's drops and then drops again. So it's giving a trap basically for traders that want to chase it going lower, thinking this is a bear flag and they're going to look for it to go down in here or maybe into these levels or this old low. So we can forget this whole retail logic. Okay, that's nonsense. It's absolutely nothing like that is going to give you consistency. It's going to give you more reasons to have a losing trade than it is going to give you precision. So the market starts to trade higher as a result. And now we have to go back to this old high, which is a high resistance liquidity run signature. So notice what happens here. The algorithm goes real close to it and then drops. So it's a delayed delivery above here, which is exactly what you expect in a high resistance liquidity run. So while this is going up, it's going to be met with a lot of tug of war back and forth before it clears it. Okay? So watch what happens. When you see these failures to go above a high resistance liquidity run and it starts to retrace, your eye should immediately go to wherever there's an imbalance, because that's why it's going down there. Or it's going below a short-term swing low. Well, there really isn't a swing low of any importance here that I like that isn't really pushed to the sidelines because of this clear, obvious buy-side imbalance, sell-side inefficiency. So you can see the discount fair value gap here. Why is this a discount? From this low to this high, 50 is equilibrium. We were below it, and it's rebalancing. So the bottom line is all we're doing is giving structure and context as to why price should be delivered as it is. But look what's happening. The same thing that's occurred down here, there's a change in the state of delivery. Buy-side imbalance, all of this right here is the same thing all this was. This drops down, and the fact that it drops down into this area here, there's a change in the state of delivery. But it's referencing an old delivery where it's been buy-side only. So where do the signals form? Where do the order blocks? Where are the fair value gaps? Where's the breakers? Where do these PD arrays? Where are the ones that work? How do you figure out what they are? When the market trades down into it, that sell side delivery of price into a buy side imbalance, that's when the algorithm will reprice and go higher. Now this one overshoots a little bit. Now this tail on this candle, if you go through TradingView and look at all of the different data feeds, you'll see that this low is different pretty considerably across the board. And if you have live accounts, look at your own low there as well, and you'll see there's a discrepancy between what your low and all these other lows will be, because this is a run on liquidity. That's the part that makes this difficult, because everybody wants it to stop exactly at that high when it's not necessary. All we needed to do is trade into the fair value gap, and we allow for it to trade down below this low. Now that may be more pips than you're willing to assume. Well, then don't trade the 60-minute chart. Wait for it to close it and then create another fair value gap or a bullish order block on a 5-minute chart or a 1-minute chart, and you'll capture something in there. Then price runs above. The delayed delivery is now ran into buy side liquidity here above this high. So once it hits that, what happens? We refer back to what? This is a high resistance liquidity run. So it does go above it, but look what happens. The market changes its state of delivery again, goes back down into the bullish order block, hits it one more time, and trades to the top of what? The fair value gap. They do not expire outside of the range of the IPTA data range. That's how I stop looking at them. Now, if they become sensitive again because of price action in recent delivery, then I'll start following them if they're outside of 60 days. If they're older than 60 days, but they're starting to show sensitivity again, then okay, fine, they're going to be reclaimed. But I don't like to look at a PD array above 60 days and expect a lot of sensitivity. It can happen, but I don't choose trades around that. And that's why we have IPTA data ranges, 20, 40, and 60-day look back. But the fair value gap, it trades to it here, finds the support with an order block, optimal trade entry. So what's the narrative still? Are we bearish? No, we're not bearish, we're bullish. So the market starts to deliver price on the upside again. Goes above this short-term high, and then what happens again? Another retrace. What's it retracing to? The order block, which is that down close candle right there, and that fair value gap. The state of delivery here is buy side only. What does it do? It trades down into it. The sell side, at the time it trades into the imbalance of the buy side, at that moment, the algorithm changes gears. It shifts. It changes its state of delivery. It's not buying pressure. to say that kind of stuff, that means like looking at charts from 1950, 1930, okay? Go back and look at all those charts. You'll see these same things occurring. You're trying to tell me that everybody was using what I'm teaching you right now? No. The market makers were turning price at that. They stopped offering lower prices because they knew how far they were going to take it down to. It was all manual then. Everything was manual. It was a group of men that would literally sit around and say, okay, we're not going to offer any more pricing lower. That's it. And then they would start offering prices higher. And then you as a trader see that and say, oh, they're bidding it up. Who's bidding it up? The traders, they're buying it up. That's not what's happening. They're controlling it. Whose storehouse is this? The market maker. Well, if we're talking about currency, who's the storehouse owner? The central bank. So whatever price they offer, that's the price feed that everybody deals with. Okay? So if you have a broker or a dealer, that desk has to work with the price that's been given and piped into them. They have no control over where that price is going to go. The only control they have is the spread. They can make that as wide or as narrow as the law will allow, but they have no control over the delivery of where that price is going to go ultimately. This is what I'm teaching you here. Every element of your study needs to go into studying the narrative, who is getting harmed, who's getting tripped, and who's getting manipulated, and for what reason. When you flesh out your charts like this, it will give you a plethora of treasures to mine all the time, and you'll be able to go back to it and refer to it at a later time when there's more price action, and you'll see how all these things start to dovetail together. It's one thing for me to sit in front of you every week and say, this is where I think it's going to happen, and by the end of the year, it's going to look like this on your chart. And then when it happens, it's like, wow, it happened. And you forgot all the time in between. So this is what you do. You go through your charts and you fill in all those gaps where you thought it was just nothing to be paying attention to. This is what I'm referring to. It's very expensive here. You have to spend time on your charts. You cannot get this information from me doing it. I can do 3-4 hour long videos. It's still not going to scratch the surface of you going in and seeing it yourself, because there's many things in this chart here that I'm not pointing to, not because I don't want to talk about it, or not because it's not something you've already learned, or that I'm hiding it from you. It's just because of the scope of time doesn't permit it. Like, there's so much more to talk about. For instance, we have consolidation here. Market runs up and we have a breakdown. This is a market maker sell model. What? Yes, this is a market maker sell model. But remember, the sell model can sometimes reaccumulate over here and not run out the original consolidation. Oh, that's all part of this same fractal as well that supports the narrative. But then you have this market maker buy model. Consolidation, breaks, returns to consolidation, smart money reversal, low risk buy, reaccumulation, another level of reaccumulation, and boom, clears the original consolidation out. Everything will start to dovetail once you start putting the pieces together modularly. You have to do it bite-sized. You cannot eat the elephant with one gulp. You got to take one bite at a time and expect to spend a lot of time. You're learning the most difficult thing on the planet because you're standing in front of yourself saying you can't do it or it's too hard. When I'm just telling you, it's going to take work. It's going to be hard in the beginning because it's hard like exercise. Nobody wants to do it. But once you get into it and you start doing it for 60 days, if you can work out consistently for 60 days, then you've overcome that initial hurdle. And it's pretty easy as long as you continuously take yourself to the gym or work out. You'll be able to be fine with it. This is no different. You have to replace bad habits with something else. And it takes about 60 days to do that. So if you go through your practice of every single day, spending about 30 minutes, maybe as much as an hour, but I wouldn't do anything more than that. But you have to do it every day. Go into your charts, really annotate them, study them, think about why would have done something like this, and why is it doing what's doing over here? What's it trying to do? Okay, and then look for when the state of delivery is changing. Okay, when it's opposed to the underlying narrative, it's bullish back here. It's bullish right here. It's here and here. Every single time it's trading down into an area where there was buy side delivery offered, and the delivery is changing its state to sell side and overlaps with that moment when it was buy side, That is efficiently balanced. That means at that moment, that's when you anticipate the algorithm changing gears. Not buyers are coming in or sellers stop losing momentum or start losing momentum on the sell side and now buyers take over. That's not what goes on. That's not how this works, folks. I know it feels like it because you have so many books that tell you that and so many people you probably have a lot of respect for. That's not me. Okay? And they tell you this stuff over and over again. It's buying and selling pressure. It's supply and demand. It is nonsense. This is absolutely a Ponzi scheme. Okay? It's always been that way. It just gives you all these reasons to think that it's something that it's not. Okay? Because if they can tell you that it's those things that you readily admit that they're going to fail a lot, and you can be profitable if you have 5-to-1 reward to risk ratio. What does that mean? That's saying that you could be 60+% wrong. And you go into that thinking, well, I could be 65% wrong and still be profitable. Are you going to go to a job and say, hey, look, you're going to work 65% of the time and not get paid? You're not going to work that job. But that's what they're doing. They're giving you that coming in the door, and nobody's going to sit down and frame a trade that's 5-to-1 or more. They don't have that skill set because they don't have this skill set here to sit down and have a real interest in understanding the fine details of why price does what it does. You have to have a narrative. What is it doing? Is it going to go higher or is it going to go lower? Why? What makes it bullish or bearish? That's what I teach you. Relative to that weekly chart. Is the next weekly candle going to expand to the upside or is it going to expand to the downside? That's your number one question. What's going to happen on that weekly candle? You're not predicting the close. You're not trying to predict exactly how high it's going to go. You just need expansion. Okay? Once you have expansion, that means opportunity. And you work within that bias. And if you're wrong and it doesn't go in that, then you're wrong. It's nothing wrong. It's not going to kill you. But once you have that narrative, you stay with it. And you look for all of these little pieces of the puzzle because they're not going to hide it from you. They can't. That's the beautiful thing about this. When you understand the state of delivery and when it changes and then it overlaps where it was a previous state of buy side and it offers it into sell side, as it's trading down like that, every retail book out there says nothing about buying when it does that. They like to see it when it's already turning. Okay, or they're looking at an indicator. And once it goes down here and hits this, there is a bullish divergence if you look at an indicator right there. That's when they work. But it's not because the divergence is there. It's because the narrative overlaps with what I'm showing you here. The delivery of price controls everything. And it's hinged on time and price. Once you have that and you understand the states of delivery where it's buy side then changes to sell side, when you're bullish, that's where the signals are going to form because the algorithm will turn on a dime there like it does here and here and here. Think about it, folks. Before you met me, before you did any of this study with me, okay, you never saw turning points like this and understood why it was happening anywhere. It was not in supply and demand, not in Elliott wave, not in support and resistance, none of that, harmonic, none of it. None of it had this level of precision. But you're learning the highest order of precision there is in these markets because you're learning exactly what makes these algorithms turn and when they reprice and how they should price aggressively, one-sided, or how they do it in a sputtering context like this. I'm teaching you how these markets create these choppy but eventual run through. You never learn that in a retail book. You never see that. Folks, I got over 2,000 plus books, and I'm telling you, I've never, ever, ever seen anybody teach the idea of a high resistance liquidity run. It doesn't happen. It does not happen. But you're learning that. What's the benefit of that? You can trade in them, but if you can understand also what they look like here, while they're still profitable, it's better to focus your time and energy on low resistance liquidity runs because you're going to get that immediate feedback. You're going to get that easy run to your target. Doesn't mean you're going to 100%. It just means that you'll find in contrast that that's the easier way of trading. And by knowing what these trades look like, you can filter out your expectation of fast runs while it's like this, but still submitting to the idea that it's a higher time frame premise. So it's just going to take more time for your targets to get through and not trail your stop loss up so aggressive and so fast, because you're going to get these types of movements where it's whipping back and it'll stop you out before the real move takes place. So hopefully you got something out of this, and until I talk to you next time, it probably won't be until 2021. So just let you know, it'll probably be Sunday. We'll have this weekend's teaching because family plans came up, and I'm not going to have the time to sit in front of the charts and the computer to build up your weekend lesson. So until I talk to you next time, be safe and Happy New Year.